Okay, hello everyone, and welcome to this day 2 of AFM or P4 webinar being conducted by ACCA before the exams to ensure that students get a firm grip of the concepts and a good revision of the concepts. And like yesterday, firstly, quick recap of that issue, that my voice is clear to everyone and my video is clear to everyone and the screen is clear to everyone, stating AFM webinar day 2 currency risk management. Okay, so there's just one message that voice I cannot hear. So I think that's probably an issue from their side, the student side. Everything is clear. Okay, so let's start. Okay, so as discussed in yesterday's class, in day 1, we were basically inclined towards coverage of investment appraisal. Okay, so we discussed one question of investment appraisal and the basics of investment appraisal. Now in today's session, we are going to have a discussion on currency risk management, right? Again, like yesterday's session, firstly, I'm going to explain you the key concepts. And after the discussion of the key concepts, we will do one past exam question, which will help you to understand these concepts, okay? And again, after every 10-15 minutes of lecture, I will make sure that I look at the questions tab to ensure that if there are any questions, we answer them immediately, okay? Now, when currency risk management is starting, the first thing a student needs to know is that what exactly is currency risk. When a student plans to do currency risk management, the first thing he should consider or learn is that, or he wants to know that, what exactly is currency risk, okay? So we basically define currency risk is the risk that currency rates may go up when we have to make payment in future, or risk that currency rates will go down if we have to receive payment in future. Now, even if someone has less knowledge about currency markets, one thing everyone knows is that currency rates never remain stable. Okay, there's always a change in currency rates, right? You cannot say that currency rates are going to remain constant forever. Obviously, the currency rates keep on changing. Okay, because of this movement in currency rates, like today, I might see that dollar is at another rate, and tomorrow I might see dollar at another rate, and 1 month later I might see dollar at another rate. So currency risk basically arises due to movement of currency. It is the risk that currency rates go up when we have to make payment in future. If we plan to pay someone in future, there's a risk that currency rates may go up. And if we are receiving money from someone in future, there's a risk that rates may go down. This is basically currency risk. Like for example, I'm in Pakistan. Okay. And today is 17th November. Okay. I'm in Pakistan and today is 17th November. Let's suppose I bought goods from a US company for $1,000. I bought goods from a US company for $1,000. Okay. And I have to pay them in, let's suppose, January 2021, after 3 months, 2 months. Do you think the currency rates are going to remain stable for the next 2 months? No. No, I'm not guaranteeing you that the rates will go against, it's just a risk that if you have to pay someone in January, there's always a risk that till that time the rates may go against you, the rates may go up and you incur a loss. That's currency risk. Or, for example, you will be receiving euro 5,000 in February 2021. So if you are receiving euro 5,000 in February 2021, there is always a risk that till that time the rates may go down for euro. This is currency risk, that if you have to make payment to someone, the person is always afraid that the rates may go up. And if you are receiving money, there's always a risk that rates may go down. This is currency risk. Like this specifically happens whenever a student tries to or wants to submit examination fees to ACCA UK in future. Now let's suppose for your next attempt you have to pay examination fees to ACCA UK in March. And let's suppose your examination fees is GBP 100. Now from whichever country you belong, except from UK, if you have to pay 100 GBP to ACCA UK in future, everybody is afraid of this risk, that till that time the pound rates may go up or go against you. This is currency risk. But if you have to make payment to someone, there's always a risk that rates may go up. If you're receiving money from someone, there's always a risk that rates may go down. This is basically currency risk. Now, one thing is that no one can avoid currency risk. It will be happening. No one can avoid currency risk. However, currency risk can be managed. You cannot avoid currency risk, that okay, currency risk can be avoided. No, it can never be eliminated. It can only be managed, minimized. That's what your topic is, not currency risk elimination, but currency risk management. Because we all know we cannot avoid currency risk, we can only manage currency risk. And currency risk is basically managed through the use of some hedging techniques. Currency risk is basically managed through the use of some hedging techniques. Okay, so basically I told you first that currency risk is the risk that currency rates will go up if you have to make payment, or currency rates may go down if you have to receive payment. I give you an example that I'm in Pakistan and I have to pay someone $1,000, let's suppose after 2 months. There's always a risk that rates may go up. Similarly, we have to pay fees to ACCA UK in March. There's always a risk that pound may go up. This is currency risk. Okay, no one can avoid currency risk. It can only be managed. How currency risk is managed? It is through the use of some hedging techniques. Okay, now basically there are many hedging techniques to minimize or manage currency risk, but the most important techniques are 3 hedging techniques which we are going to cover, because in every question these 3 techniques usually come. One is called forward exchange contracts. Okay, other is called currency futures. Okay, and the third is called currency options. Now there are some other techniques as well, like lead payments or money market hedging, but obviously we are only going to cover some important techniques which usually come frequently. So currency risk is basically managed through the use of some hedging techniques. Now the 3 most commonly used and commonly examined hedging techniques are forward exchange contracts, currency futures, and currency options. Okay, I'm going to discuss all 3 techniques with you through some examples, and then we will be in a position to go towards a past paper question. Okay, any question up till now? I've sent you my number again. So those who are unable to join the WhatsApp group yet, although I think we have majority students in the WhatsApp group now, but those who are unable to join, just drop me a text WhatsApp there. I will send them the link. Okay. Now, obviously, there are 2 or 3 students that are asking about lead payments or money market hedging or currency swaps. Obviously, I told you initially that there are many hedging techniques. Okay, but obviously, if there's nothing. If we discuss all hedging techniques, then obviously whole 5 days would just be spending on these hedging techniques. So obviously we are going to cover the most frequently examined hedging techniques, and those frequently examined hedging techniques are 3. One is called forward exchange contract, one is called currency futures, one is called currency options. And if you want to study some other techniques, you can always contact me through WhatsApp, so we can do something about those other techniques if you want to study that. Okay, so let's move forward. So I told you that currency risk can never be eliminated or avoided. It can just be managed, and it is managed through 3 commonly used and examined techniques: currency futures, options, and forward exchange contract. Now the first technique is called forward exchange contracts. Okay, now remember, to solve any of the techniques you need information about the quotes, which we discussed in the last session, that if foreign currency is in numerator, local currency is in denominator, we call it indirect quote. We divide and lower rate by higher rate sell. Okay, similarly, if local currency is in numerator, foreign currency is denominator, that's a direct quote. In direct quote we multiply, and the lower rate is the selling rate and higher rate is the buying rate. Those of you who have joined the session directly without watching yesterday's session, I would advise them to watch that session also, so that they get an understanding about course. Okay, so currency risk is the risk that currency rates may go up if you have to make payment to someone, or currency rates may go down if you have to receive payment from someone. Okay, And no one can avoid currency risk. It can just be managed. So currency risk is managed through the use of some hedging techniques. There are three hedging techniques: forward exchange contracts, futures, and options. Now, I'm going to teach you very, very easy methods of these techniques. They may be different from the examiner's answers, but obviously the answers will, final answer will be the same. The approach may be different, but you will really enjoy these techniques, okay? The first technique is forward exchange contract. So forward exchange contract is basically a contract of rate fixation in which we fix a rate for future transaction. Forward exchange contract is basically a contract of rate fixation in which we basically fix a rate for future transaction. Okay. Now let's suppose you have to pay 100 GBP to someone, ACCA, in March, and you are facing a risk or you're afraid that rates may go up. Just fix a rate with a bank or a money exchange company or whoever. If the rate is fixed, now no matter whatever the rate is in the future, you won't suffer any loss. This is basically forward exchange contract that we fix a rate. Or let's suppose in 4 months, you will be receiving 1000 USD from someone. In receiving, you're always afraid that rates may go down. This is currency risk, okay? What to do? Fix a rate. This is forward exchange contract that you fix a rate for a future transaction, okay? So for example, through these examples, you will learn how these quotes are applied here. I am in UK and I will have to pay $2,000 after 3 months. Rates are dollar over pound. Spot rate, today's rate 1.2-1.25. 2-month forward rate 1.21-1.26. And 3-month forward rate 1.205, 1.20. Requirement is how much GBP or pounds will be involved in forward exchange contract. Now the good news is that if you understand the principles, forward exchange contract is just a one-line solution. Forward exchange contract is just a one-line solution. It's just solved in one line because the whole marks are for quotes. The whole marks are for quotes. If you understand the quotes, that's what it is wanting to test. So the example is I am in UK and I will have to pay $2,000 after 3 months. Okay, the company is in UK and it has to pay $2,000 after 3 months. Okay, so if you have to pay $2,000 after 3 months, there's always a risk that dollar rates may go up. Rates are dollar over pound. Spot rate, today's rate is given, 2 rates are given, 2-month forward rate is given, and 3-month forward rate is given. How much pounds will be involved in forward exchange contract? Okay, how much pounds will be involved? Now, let's listen how forward exchange contract answers. It's very easy. Now, the company is in UK and has to pay $2,000 after 3 months. Remember, if you have to pay someone after 3 months, only this 3-month rate is relevant, no other. If you have to pay someone after 4 months, only 4-month rate is relevant. If you have to pay someone after 2 months, only 2-month rate is relevant. So if you have to pay someone after 3 months, only this 3-month rate is relevant. So highlight this. Number 1. Number 2, gather the quote. You are in UK. You are in UK. What is the local currency of UK? It's pounds, it's in denominator. It's an indirect quote. Indirect quote means you will divide to convert. And this lower rate is the buying rate, higher rate is the selling rate, right? What was the first step? If you have to pay someone after 3 months, only highlight the 3-month rate. Second, if you're in UK and pound is in denominator, indirect quote, divide, lower buying, higher selling. Last step, just solve the answer. Okay, how much you have to pay? $2,000. How much you have to pay? $2,000. Question asks how much pounds will be involved. You have to pay $2,000. How much pounds will be involved? To convert it into pounds, multiply or divide? Divide. Now you have to pay. If you have to pay someone, how will you pay? Will you enter into a buying contract or selling contract? Now, if I have to pay ACCA 100 pounds, I have to enter into a buying contract. I have to buy 100 pounds from the bank and then pay. If you have to pay someone $1,000, you have to first buy from the bank and then pay. So in payment, you have to buy. So apply the buying rate 1.205. Okay, so let's open the calculator. It's 2000 divided by 1.205, 1659 GBP. This is the answer. I'm repeating. First step, if you are paying after 3 months, only highlight the 3 month. Second step, quotes. Pound is in denominator, indirect quote, divide, lower buying, higher selling. You have to pay 2000. How much pounds will be involved? Just convert it into pounds by multiplying or dividing. Dividing, it's an indirect quote. Payment means we have to enter into a buying contract, use the buying rate, that's it. Improve it further. Another example, then you can copy. Another example, then you can copy. Okay, I am in Europe and I will receive $2,000 in 4 months. Okay, I am in Europe and I will receive $2,000 in 4 months. Rates are dollar over euro. Spot rate, two-month forward rate, 4-month forward rate. Required. How much euros will be involved in forward exchange contract? Remember, it's just a one-line solution. It's just a one-line answer. Okay. So you are in Europe and you have to receive $2,000 4 months. Only relevant row is 4 months. If you're in Europe and you will receive $2,000 in 4 months, only 4-month row is relevant. Second step, quotes. You're in Europe, the currency is euro, it's in denominator, indirect quote. You need to divide to convert. Okay. Indirect quote, lower rate is the buying one, higher rate is the sell. Now the last step, perform the calculations. How much you will receive? 2,000. The question asks how much euro will be involved. So you will receive $2,000. The question is asking how much euros will be involved. You will convert it into euros, multiply, divide. You are receiving. So if you are receiving something from someone, if you're receiving, what do you do in your country? If you're receiving money, you sell it to the money changer. If you have to pay, you buy from the money changer. If you're receiving, you sell it to the money changer. So apply the selling rate 1.17. So 2,000 divided by 1.17, it's 1709 euros. So getting it how forward exchange contracts work. Okay, you can quickly copy these two examples and then we can move forward. Yes, Afzal, it will be covered. And Hassan, for buying, whether we use low rate or high rate, we cannot learn like this low rate or high rate. That's why in the second step, I told you that you need to first note the quotes. So if the quote is indirect, then the lower is buying, high rate selling. You write BR buying rate, SR selling rate. Okay, if it's indirect quote. Okay. In payment, always use the buying rate. In receipt, always use the selling rate. Okay. Similarly, if it's a direct quote, in direct quote, higher rate is the buying one, lower is the selling one. So write BR and SR. In payment, always buying rate. In receipts, always selling. Alvin, we have already discussed yesterday that if forward rates are not given, then we will be provided data about parity theories. We can find through that. Okay. Sarva, money market hedging is the most easy technique among all. That's why it is not being covered here. However, you can contact me later after class. We can make an arrangement regarding this. So Jason, if 4-month rate is not given, so we always have the parity theories data to find the rates if any rate is not given. So Ambika, there is no explanation of buying and selling rate. It entirely depends on quotes. Now, if the question has indirect quote, then the rule of indirect quote is division, and the rule of indirect quote is the lower buying, higher selling. Okay. And if you find the question that it's direct quote, then it's multiplication rule, and lower is selling, higher is buying. So you have to first find the quotes, then you can only get whether it's a direct quote or an indirect quote, then only you can get buying rate, selling rate. Satya Sarvani, your question is regarding futures. So you have to wait till we cover futures. We have not yet moved to futures. Murtaza, the quote can only be guessed when numerator denominator is given, else you can never apply the quote. Yes, Izza, unless you know the home country location, you can never understand the quote. MD Siam Hussain, that's a way of expressing the currency rates. Like for example, you are in Bangladesh. So either it will be Bangladeshi taka per dollar or dollar per Bangladeshi taka. You can go to any money changer website, any bank website, rates are given in two currencies form. So whatever is the home country, if it's in denominator, that's an indirect quote. If the home country is in numerator, that's a direct quote. One last example of forward exchange contract. For example, the question states, we are in Thailand and will be paying pound 1,000 in 4 months. Rates are Thai baht per pound. Spot rate 40-42. 4-month forward rate, 6-month forward rate, 41, 43, 44, 45. How much Thai baht will be involved in forward exchange contract? Now immediately apply the 3 steps which we have covered. Firstly, we are in Thailand, we'll be paying £1,000 in 4 months. So only relevant row is 4 months. Step 1, only relevant row is 4 months. Second, apply the quote. You are in Thailand. So the currency of Thailand is Thai baht. That's a numerator. That means it's a direct quote. That means you will multiply to convert. And that means lower rate is the selling rate, higher rate is the buying rate. Okay. Finally, apply the last step. The first step, highlight the relevant row. Second step, quotes. Now, apply the answer. You have to pay £1,000. The question is asking how much Thai baht will be involved. So convert these £1,000 into Thai baht. Multiply or divide? Multiply, because it's a record. You're paying. So in paying, you always contract to buy currency. You have to buy to pay. So apply the buying rate 43. It's 43,000 THB. Okay. Any more questions regarding this? You can ask. And then we can move towards the second technique, that is currency futures, and you can note the stuff for currency futures as well. Yes, Ayuni, the main key is where you are based. Then only you can decide the quote. Keshav, you cannot learn like this, that we divide it by lower or higher rates. We can divide it by lower rate as well or higher rate as well. Lower or higher doesn't work. The buying or selling works. When you are receiving, you have to sell. So always the selling rate will be preferred. So if it's an indirect quote, the lower is selling, higher is buying. And if it's direct quote, Sorry, if it's direct quote, then lower is selling, higher is buying, and if it's indirect quote, then lower buying, higher selling. So you have to decide the quote, then only you can use the selling rate. You cannot say that we divide by higher rate or lower rate, because you divide it by selling rate, right? In receiving, you use the selling rate. So selling rate can be higher, selling rate can be lower. It depends on the quote. Yes, Mohammed Mehdi, you can use like this. Yes, at the rate of, you can use like this. Okay, the next technique is the currency futures technique. Okay. Now in currency futures technique, futures are also similar to forward exchange contract with some slight differences. They also fix a rate with some slight differences. Okay. Now there is a three-step approach of futures, which if you're able to do, then you can definitely score full marks in futures. Now the first step of futures is to find lock-in rate. The first step of futures is to find lock-in rate. Okay. Now what is this lock-in rate? Some people called it extrapolation rate. Some people call it average rate. I call it lock-in rate. The first step is to find this lock-in rate. Now, what is this lock-in rate or average? Let's suppose you have to pay someone in 3 months. Okay. So you need rate for 3 months, right? When you see the question, you are given 2-month rate, 4.5. Okay. 6-month rate, 4.9. Now this doesn't work here, right? You have to pay someone in 3 months. You need a rate for 3 months. If 3-month rate is given, fine. But if you are given 2-month rate and 6-month rate, 2-month rate is 4.5, 6-month rate is 4.9, you need a lock-in rate or an average rate. How will you get it? Okay. Let's suppose 2-month rate is 4.5 and 6-month rate is 4.9. What is the trend? Rising or falling? Rising. 5.4. In how many months? It's rising by 0.4 in 4 months. So if it's rising by 0.4 in 4 months, so it's rising by 0.1 per month. So it's rising by 0.1 per month. So take the 2-month rate, 4.5, and it's rising by 0.1 per month. So you have to go 1 month forward, right? From 2 to 3. So if 2-month rate is 4.5, it's rising by 0.1 per month. So till 3 months, it would rise by 1 time. So the 3-month rate will become 4.6. This is called lock-in rate or average rate. Okay, I repeat. You have to pay someone in 3 months, you need a 3-month rate. If 3-month rate is given, it's fine. If 3-month rate is not given, instead 2-month rate and 6-month rate is given. 2-month 4.5, 6-month 4.9. It's a rising trend of 0.4 in 4 months. So per month, it's rising by 0.1. If it is rising by 0.1 each month, take the 2-month rate. You need to go to 3-month rate. Add it 1 time because it's increasing. It becomes 4.6. To make it further clear, let's suppose you have to pay someone or you have to receive from someone in 5 months. If you have to receive from someone in 5 months, you need a 5-month rate, right? If 5-month rate is given, fine. Let's suppose the question gives 3-month rate as 6 and 6-month rate 6.6. Okay, you need a 5-month rate. Apply the averaging strategy. What is the trend? Rising by 0.6 3 months. So rising by 0.6 in 3 months means per month it is rising by 0.2 per month. If something is rising by 0.6 in 3 months, so per month the rising is 0.2. You need a 5-month rate. Okay, so the 3-month rate is 6. 3-month rate is 6. It's rising by 0.2 each month. So if it rises by 0.2, it would go to 4 months. And if it rises by further 0.2 per month, it goes to 5 months. From 3 to 5, you need to rise it by 2 times. This becomes 6.4, 5-month rate. This is called the lock-in rate or average rate. Now you must not rote learn this. Now it is always going to be a rising trend. Okay. Let's suppose you have to pay or receive to someone in 6 months. You need a 6-month rate. Okay. Let's suppose 3-month rate is given as 8. Okay. And 8-month rate is given as 7.5. If you have to pay in 6 months, you need a 6-month rate. You are not given 6-month rate. Apply the lock-in rate strategy. 3-month rate is 8, 8-month rate is 7.5. The trend is declining 0.5. Trend is declining 0.5 in 5 months. If something is declining by 0.5 in 5 months, so per month it's declining by 0.1. If something is declining by 0.5 in 5 months, so it's 0.1 per month. You need a 6-month rate. Take the 3-month rate 8. It's decreasing by 0.1 every month. So if you decrease it by 0.1, it will become to 4 months, 0.1 per month, from 3 to 4 one time. Further decrease by 0.1, it will reach 5 months, and further decrease by 0.1, 6 months. If 3 times decrease by 0.1 each month, it will go to 6-month rate. So the 6-month rate will be 7.7. You can also do 8 minus 0.1 into 3 directly, but that's what lock-in rate is. Okay. Any questions with respect to lock-in rate? Christiana, I'm not explaining it through the basis approach. I'm explaining through some separate approach, and this is very easy. Trust me. So follow this approach, please. Jason, you can average it or take lock-in from anything. It's up to it's your choice. Afzal, this is not the same as basis method. Basis method is quite complicated. Rabia, because we need to reach to 6-month rate. So from 3 months to 6 months, it's 3 times, not 2 times. Yes, Kritika, this method will work in all cases. Yes, Tajwar. Izzah Atira Abdul Rahman. If you take the higher rate and do the adjustment, you will also end up using the same answer. Damilar, that's why I've stopped. You can copy it quickly. Abid Hussain, obviously, maybe if you are studying from someone else, he would have some other method. Book BPP has some other method. Kit Kaplan has some other method. So that's a question which cannot be answered, that why the book has a different calculation method. Book has a method. Obviously, my approach is to find more easier methods. We work on that. We have researched on that. That's why our method is different. As long as the answer is the same, you need not to worry. Macaco, it's the same thing. Yes, through the basis method, Ambika, you will get the same answer. Amalchand, you can replace this method. Shalima, I am not getting your question. Why minus 0.13 times? How will you go from 3 months to 6 months? If you will just do the adjustment of 0.1 for 2 months, so if you will do adjustment for 2 months, 2 times, you will end up at 5. To go to 6, you have to do 3-month adjustment. Yes, Afzal, you can use that. For all those students who are saying that will we get the same answer with this method? Yeah, that's why I'm teaching. Else, if you're getting some different answer or the method is not acceptable, I would have not taught you this method. Sama, your question is very funny. If this method would give you half marks, so why would I teach this method? Now, Satya, the averaging strategy only applies on starting and ending. Average cannot be out of range. Veronica, that will be discussed tomorrow. Amna, that's not the case. You can use basis method or this method. There is no condition of that. Now let's just copy some stuff from the third technique, currency options. I will explain you this and futures. The first step was lock-in rate. Now the second step which you have to show in the exam is to find the expected receipts or payments using this lock-in rate. Now once you get your desired rate, the lock-in rate, you need to find your receipts or payments, whatever are the receipts or payments through this lock-in rate. And in the last step, you have to show the number of contracts. Now, how these two steps are done, I will show you in the question. But at the moment, the first step is to find the average rate or lock-in rate. Then once you get the lock-in rate, you can use that to find the receipts or payments, and then you have to show the number of contracts. Satya, that's not possible. That's what I was trying to say, which you just change the example from 2 months to from 4 months to March and December. It's the same. You cannot do. Either you will be given spot rate, today's rate, and 6 month rate, so then you can find a 3 month rate. Else it's not possible. Okay, you can copy this stuff, then I will explain you the steps and then we can move towards the past exam question. So use. Unit means so use. Okay, so when we will discuss currency options, maybe the method when discussed in theory, you will just find or feel that it's just rote learning. But when I explain this in a question, you will really feel comfortable with this method. Okay. Okay. So we are focusing on three techniques. That is forward exchange contract, futures, and options. So forward exchange contract was a contract of specification. I told you it's solved in three steps. First, highlight the relevant rows. Second, understand the quote. If it's an indirect quote, it's division, lower buying, higher selling. And if it's direct quote, it's multiplication, lower selling, higher buying. And finally, just apply the random calculations. If you have to pay 2,000, take 2,000, convert it by multiplying or dividing. If it's payment, buy. If it's receipt, sell. Then future is the same as forward exchange contract with some slight differences. Okay. So In futures, you have to first find the lock-in rate. I explained you in detail what lock-in rate is. Okay, then expected receipts payments using this lock-in rate. I will tell you what that means and find number of contracts. Now, last thing is currency options. Okay, after that we will be in a position to move towards the question. Now, currency options is basically also a contract of rate fixation. It's also a contract of rate fixation, but it's not a legal obligation like forward exchange contract. Forward exchange contract was also a contract of rate fixation. This is also a contract of rate fixation. In this also we fix a rate, but this is not a legal obligation like forward exchange contract. In options contract, either we can exercise option or okay, currency options is also a contract of rate fixation. Okay, but you fix a rate. If you fix a rate in forward exchange contract, you have to take the contract under any circumstances, whatever your issue is, either you are stuck, whatever, you have to fulfill that contract. But in currency options, you just enter into a contract of rate fixation, but depending on the circumstances, you can exercise it or leave it. If you leave, you just have to pay a premium and leave. You can leave the contract. You cannot fulfill your contract, but in forward exchange contract, there's a legal obligation to fulfill. Now, in currency options, remember one rule. If either you are going to get a payment case or a receipt case, there is no other case. Remember, if you have to pay someone, whenever you need to pay, you need to buy currency from the money changer. Buying means you will always use call option. Call means buying contract. Okay. And in receipt, you have to sell something. If you're receiving something, you will sell it to money changer. So selling means you will use put option. So people have this learning habit that in payment we use call and in receipt we use put. Fair enough till now that in payment, obviously when you have to pay someone, you have to enter into a buying contract with the money changer. You will buy and then pay. If you are paying 100 GBP to ACCA, you first have to buy from the bank and then pay. So use call option buying. And if you're receiving someone, you need to sell, use put option. Okay. Now, if the question is for payments, the formula for payments is number one, expected payments in our currency using exercise price plus unhedged payments plus premium payable. The formula for total payments is expected payments in our currency using exercise price plus unhedged payments plus premium payable. Okay. Now, how do you get this one? The expected payments. This is the detail. The expected payments or receipts, it's calculated as number of contracts into contract size. Number of contracts into contract size. Number of contracts as a sub formula. Expected payment or receipt in foreign currency over exercise price over contract size. Through this, you get number of contracts into contract size. Okay, this is how you get the first thing, expected payments, through this sub formula. Number of contracts into contract side, and I have the sub formula for number of contracts. Okay. Now, whenever you will enter into an options contract, options contracts have a standardized contract size. Like for example, you have to fix the rate for 110,000 GBP or 120,000 GBP, they won't apply. They have standardized contracts of 100,000, 200,000, 50,000. They are not as per your own wish. So obviously, when you enter into an options contract which is standardized, you won't be able to hedge your full amount. There is some unhedged amount left. How this unhedged amount is calculated, number two, it's expected receipt or payment in foreign currency less number of contracts into contract size into exercise price. Expected receipt or payment in foreign currency minus number of contracts into contract size into exercise price. Remember, if you have to pay someone $60,000, you need to fix a rate for $60,000. That's not possible in options contract. They have a standardized contract size. So you won't be able to enter into hedging contract for full amount because the standardized size, some amount will be left as unhedged. Unhedged is computed this way. And finally, you have the number third thing, premium payable, because in options contract, you always have to pay some premium so that if you want to leave, you can lose this premium. So this premium is calculated as follows. Number three, number of contracts into contract size into premium. Now remember two further rules. Whatever unhedged amount is left, there is no technique which deals with this unhedged leftover amount. because options are standardized, they won't hedge that small petty amount. Futures are also standardized, they won't hedge this small petty amount. So unhedged is only dealt through forward exchange contract, because in forward exchange contract there is nothing as such a standardized contract size. You can hedge a petty amount as well. So unhedged is only dealt through forward exchange contract. And one thing which you need to remember for premium is that in options contract, premium has to be paid immediately now. So in premium, you have to pay immediately. So immediately means you need to use spot rates. That's the detailed approach for payments. That total payments is the expected payments in our currency using excess price. The breakup, how to find, it's as follows. Number one, plus unhedged. I gave you the concept of unhedged, that since it's a standardized contract, whole amount won't be hedged. Some amount would be left as unhedged. Okay. And plus premium payable. Premium is number of contracts into contract size into premium. Premium has to be paid immediately, so we use spot rates. Unhedged petty amount is never dealt through futures or options. They're through standardized contracts. It will only be dealt through forward exchange contract. Now, in case of receipts, the principal formula is a bit different, else everything's the same. The formula for total receipts is number one, again the same. Expected receipts in our currency using exercise price, it's calculated in the same manner. Number of contracts into contract size. Then unhedged, obviously because of standardized size, some amount will be left as unhedged. It's computed in the same manner. Expected receipt or payment minus number of contracts into contract size into excess price minus premium payable. Now, one thing which is different is that in payments you are adding premium, and receipts you are deducting premium. That's very normal. Premium you have to pay. Premium you have to pay. So it increases cost. Premium has to be paid, it increases cost. So in payments it increases cost. That's why we're adding. But premium has to be paid. In receipts case, the premium reduces your receipts. The premium reduces your receipts. You have to pay premium, it reduces your receipts. Therefore, we are deducting. The sub formulas are the same. Everything is the same. But in options contract, you have to make sure that you understand this, that what is this unhedged receipts or payments? The basic computation is the same, but obviously since options is a standardized thing, you won't be able to hedge all amounts. Some petty amount will be left as unhedged. So that's only dealt through forward exchange contract, and premium has to be paid immediately. So we use spot rates. Okay. Now this is a bit too much formulas, but once you are getting this in a question form, that would be quite easy. Okay, so in options, I told you that if you are paying, you have to buy currency, use call option. In receipts, you have to sell currency, use put option. That's fine. Payment, call option, receipts, put option. The formula for payments and receipts, the number one thing is same, expected payments or receipts. Number two is the same plus unhedged, but premium is the same, but it's added and deducted, because premium payable reduces your receipts, therefore deducting, increases your payments, therefore adding. The sub formulas for expected receipts or payments, number one is the same. The unhedged formula is the same. The premium is the same. Premium has to be paid now. Use spot rates, and unhedged is only dealt through forward exchange contracts. Okay. Any questions? Yes, unhedged you only use forward exchange contract. Unhedged is basically that futures and options contract are standardized. Okay, so if they are standardized, we cannot hedge each and every amount. Some petty amount will be left. That is called unhedged. Premium has to be paid immediately. Therefore, immediately means we use spot rate. No, FNIA, you cannot hedge it through currency futures, because currency futures is also standardized. It can only be dealt through forward exchange contract. Abid, it's your choice whether you want to write or not. Afzal, that's a basis approach. We are not following the basis approach. We are following a different approach. Anjali, wait till we do the question, please. It will be all clear. So up till now, we have discussed what is currency risk. There is that currency rates may go up if you have to make payment, or currency rates may go down if you have to receive payment. The common hedging techniques are, because you can eliminate this risk, futures, options, and forward exchange contract. Forward exchange contract is a contract of rate fixation, and it is done through 3 steps. The first, highlight the relevant rate, then expected receipts payments using this first highlight the relevant rate. If you have to pay after 2 months, highlight the 2-month rate, then understand the quote, and then multiply or divide by that buying or selling rate, because payment, buying rate, receipt, selling rate. In futures 3 steps: lock in average rate, expected receipts payments using the lock-in rate, and number of contracts. And options, if paying, call option, buying contract, receipt, sell option, put option, selling contract. Okay, we have the formula of payments and receipts, we have the sub formula as well, and then we can be sure that once we have the sub formulas, we can use that. So one student is saying to repeat the premium has to be paid. It increases cost, therefore adding in payment, but it reduces receipts, therefore deducting the receipts. Okay, so we now have to move towards a question. Okay, so what we're going to do is, so that we don't get disturbed in the question, we will take a 5-7 minutes tea or water break, and then we will start the past paper question, so that there is no stoppage and we can directly complete the question. Yes, Alvin. So break time. Okay, so we are now resuming. Tajwar, again, you started from 3 months and you need to go to 6 months. So from 3 months to 6 months, you have to adjust 3 times. I don't know why there are 2 or 3 people who are saying it 2 times, because we are starting from 3 months and we need to go to 6 months. So it's an adjustment of 3 months. Okay, so now let's move towards the question. Just a second, please. Let me run this on the ACCA software. Just wait a second, please. Okay, so I want you all to open the question of day 2, which has been provided to you in questions tab, and as well as the questions tab, which I've provided you. It's also on the screen in front of you. Okay, basically, the question which I am going to discuss with you, that's a mixture of mergers and acquisitions plus risk management, but we will only do the risk management part because our topic is currency risk. Okay, so let's just start reading the question. Lirio Company is an engineering company which is involved in projects around the world. It has been growing steadily for several years and then maintained a stable dividend growth policy for a number of years. The board of directors is considering bidding for a large project which requires a substantial investment of $40 million. It can be assumed that the date today is 1st March. Okay, so today's date is 1st March. Now let's just note this thing that today's date is 1st March. Okay. So Lirio is an engineering company which is involved in projects around the world. It has been growing steadily for several years, has maintained a stable dividend growth policy for a number of years. The board of directors is considering bidding for a large project which requires substantial investment of $40 million. Today's day is 1st March. The board is proposing that Lirio should not raise finance through additional letter of equity. Instead, it proposes it required finance is obtained from a combination of funds received from sale of its equity investment in a European company and from cash flows generated from its normal activity in the coming 2 years. As a result, Lirio's current capital structure of 80 million and 70 million 5% bonds is not expected to change in foreseeable future. The board has asked the company's treasury department to prepare a discussion paper on the implications of this proposal. The following information on Lirio has been provided to assist in preparation of discussion. Expected income and cash flow commitments prior to undertaking the large project. Lirio's revenue is forecast to grow by 8% from its current level of $300 million, and operating profit margin is expected to be 15%. It is expected that Lirio will have the following capital investment requirements for the coming year before the impact of large project is considered. A $0.1 investment in working capital for every $1 increase in revenue. An investment equivalent to amount of depreciation to keep its non-current asset base as present capacity. Depreciation charge already included in operating profit margin is 25% of non-current assets of $50. A $0.2 investment in additional non-current assets for every $1 increase in revenue. $8 million additional investment in other small projects. In addition to the above revenue and profits, Lirio has one overseas subsidiary, Pontac Company, from which it receives dividends of 80% on its profits. Pontac produces a specialist tool which it sells locally for $60 each. It is expected it will produce and sell 400,000 units tool of next year. Each tool will incur variable cost of $36 per unit and total fixed cost of $4 million. Lirio pays tax at 25%, Pontac pays tax at 20%. In addition, a withholding tax of 8% is deducted from any dividends remitted from Pontac. A bilateral treaty exists between two countries where Lirio is based and where Pontac is based. Therefore, corporation tax is payable on profits made by subsidiary companies, but full credit is given for corporation tax already paid. It can be assumed that receipts from Pontac are in dollar equivalent amounts, and exchange rate fluctuations on these can be ignored. Now, if you have read all this question, your whole question with me, what idea did you get? What is the home currency of Lirio Company? There was discussion only of one currency, the dollars. So we can write on this platform one more thing. Home currency of Lirio is People might ask, how did you get it? It's very clear. Till the whole question has been read and read, there's only discussion of just one currency, dollar. So Lirio's currency, dollar, it's making investment, revenue, everything in dollars. Its home currency is dollar. Now next, and I need you to pay attention on this. Now the next says, it is expected that Lirio will receive euro 20 million in 3 months from the sale of its investment. Okay, Lirio will receive euro 20 million in 3 months from the sale of its investment. The euro has continued to remain weak while the dollar has continued to remain strong through 2015 and 16. The financial press has also reported there may be a permanent shift in euro per dollar exchange rate with firms facing economic exposure. Lirio has decided to hedge the euro receipt using one of currency forward contracts, currency futures contract, or currency options contract. Now, this is very interesting. Read the paragraph again. It is expected that Lirio will receive euro 20 million in 3 months. Okay, so Lirio's home currency was dollar. It will receive euro 20 million. Euro has continued to remain weak. Dollar has continued to remain strong. Financial press has also reported there may be a permanent shift. Now, if Lirio's home currency is dollar and it is receiving euro 20 million in 3 months, the home currency is dollar, it is receiving euro 20 million, there is always the risk that rates may go down. It is receiving euro 20 million after 3 months. There's always the risk that rates may go down. So you need to hedge it. So Lirio has decided to hedge the euro receipt using one of currency forwards, the futures, and options. It has decided to use one, either forwards, futures, options. Following exchange contracts and rates are available. Now, spot rates are dollar 1.1585-1.1618 per euro. 3-month forward rates are 1.1559-1.1601 per euro. For data currency futures, in currency futures, the contract size is dollar 125,000. The quotation is euro per dollar. See, in the above spot rates and forward rates, it was dollar per euro, but in futures, it's euro per dollar. So you're given March futures and June futures. Okay, remember this is always 30th March and 30th June month end. So 30th March futures and 30th June futures are given. Okay. So you're given futures for 30th March and 30th June. And then you're given data for currency options. First, you were given spot and forwards. It was per euro. Okay. Then the futures data, it was per dollar, euro per dollar. Then options contract size is also dollar 125,000. The exercise price is again euro per dollar. Premium is also euro per dollar. Excess price is 0.86. You are given call options for March and June and put option for March and June. Okay. Okay, so it can be assumed that futures and options contract expire at the end of the respective month. So I told you it's 30th March, 30th June. So they always expire at the end of the month. So it's 30th March, 30th June. Okay. Then you are given dividend history for 2013, 14, 15, 16. It is expected dividends will grow at historic rate. Dividend growth rates are given, and cost of equity capital is 12%. Okay. Now I want you all to understand this one thing, then we will move towards the solution. Understand this point carefully. Remember in the question, today's date was 1st March. Okay. And you are given futures for 30th March and 30th June. Today's date is 1st March. You are given futures for 30th March and 30th June. What does this mean? Listen carefully. Today's day is 1st March. Today's date is 1st March. You are given futures, first future for 30th March. Is it exactly after 1 month? So you can write 1 month instead of 30th March. And today's 1st March, we're given features of 30th June. So 1st March, look at my fingers, 1st March to 1st April, 1 month. 1st April to 1st May, 2 months. 1st May to 1st June, 3 months. And 1st June to 30th June, 4 months. So instead of 30th June, you can write 4 months. And this makes your life easy. This is not necessary. You can also use the March and June and do directly. Not need to convert that into months, but this is just my strategy and I consider it easy for students. Again, today's 1st March, you are given futures of March and June. Now always remember, if it's March and June, it's always 30th March, 30th June, because it's written also and it's assumed that they expire at the end of the month. So today's date is 1st March. The first future is of 30th March after 30 days, 1 month. So it's 1 month future. Okay. And then you're given future for June, it's 30th June. So 30th June is today's 1st March. You're given future for 30th June. So 1st March to 1st April, 1 month. 1st April to 1st May, 2 months. 1st May to 1st June, 3 months. And 1st June to 30th June, 4 months. Okay. Any questions in this, please? Okay, Bilal, I will repeat. Just wait a second. Afzal, your questions are always 3 steps later. Just wait, please. There is one general phenomena. We have told you that if it's a payment case, you will buy. If it's a receipt case, you will sell. Okay, so if, yes, I'm explaining it again, don't worry. Let's suppose if someone says today's date is 1st June and you're given future for September and November. So always remember it's 30th September and 30th November. So today's date is 1st June. You are given futures for 30th September. Now look at my fingers. Today's 1st June. You are given future of 30th September. So how many months? 1st June till 1st July, 1 month. 1st July to 1st August, 2 months. 1st August to 1st September, 3 months. And 1st September to 30th September, 4 months. Okay. And today's 1st June, you are given future of 30th November. So 1st June to 1st July, 1 month. 1st July to 1st August, 2 months. 1st August to 1st September, 3 months. 1st September to 1st October, 4 months. 1st October to 1st November, 5 months. And 1st November to 30th November, 6 months. Okay. In the same manner, in this question, this is not necessary. It is just for your easiness. Today's date is 1st March. Okay. And you're given March and June futures. So March means 30th March and June means 30th June. So to convert it into months, it's better. It's 1st March, look at my fingers, and the first future is of 30th March. So 1st March to 30th March is exactly 1 month. So it's 1 month future. And 1st March to 30th June, it's 1st March to 1st April, 1st May, 1st June, and 30th June. Okay, so this is just a replacement, and instead of March and June, we use 1 month. Okay, now going back to the question. I am repeating this sale of equity investment part again. That let's suppose when you read the whole question. So in this whole question, there was only dollar given, so we wrote that area of currency is the dollar. Then you were given data for 1st March 2016 is the today's date. It is expected that Lirio will receive euro 20 million in 3 months. So it is receiving euro 20 million in 3 months. And it has decided to hedge the euro receipt, because if you're receiving euro in 3 months, there is always a risk that rates may go down. So it has decided to hedge it through forwards, futures, or options. Data for forwards is given per euro. Euro is in denominator. So it's 1.1585 per dollar per euro, and 3 month rates are $1.1559 per euro. So two rates are given, spot rates and 3 month rates. Futures data, contract size is 125,000. See, there was no contract size in forwards data. It's only in futures and options. Contract size is $125,000. Quotation has changed. It's euro per dollar, not dollars in denominator for this. March, 30th March, 1 month future, and 30th June, 4 month futures are given. Okay. And finally, you are given with options data. So options contract size is $125,000. Exercise price is euro per dollar. 0.86 is the exercise price. Calls and puts are given for March, June. You can write March, June, or 30th March, 30 June, or 1 month, 4 months. Okay. Now you are doing requirement B2. Advise Lirio and recommend an appropriate hedging strategy for the euro receipt it is due to receive in 3 months' time from the sale of its equity investments. So we need to advise and recommend an appropriate hedging strategy for the euro receipt, 20 million euro receipt it is due to receive in 3 months from the sale of its equity investment. Okay, this is my requirement. So I need to requirement B2. Advise Lirio and recommend an appropriate hedging strategy for the euro receipt it is due to receive in 3 months from sale of equity investment. Okay. So we are doing requirement B2. We need to advise Lirio and recommend an appropriate hedging strategy for euro receipt. You have already discussed that they are receiving euro 20 million in 3 months from sale of equity investment. Today's date is 1st March. Home currency is dollars. Now, if you have any questions up till now relating to the question, you can ask. That then I will start the solution. Safarahim, the question doesn't seem very clear. Euro per dollar. Per dollar means dollar is in denominator, euro is in numerator. PKR per dollar means PKR in numerator, per dollar, dollar is in denominator. Okay. Okay, so when we read the question, in the first paragraph, it was written today's date is 1st March 2016. So I wrote it. What is the today's date? Okay. Home currency of Lirio is dollar. We read the whole question. Everywhere it was dollar given, revenue and everything. So it was dollar. Then it said that Lirio will receive euro 20 million in 3 months from sale of equity investment. And it has decided to hedge the risk, because if someone is receiving 20 million euros after 3 months, there is a risk. So it has decided to hedge the risk through forwards, futures, or options. We're given data for forwards, you're given data for futures, and you were given data for options. Okay, futures were given for March and June. I wrote it 30th March, 30 June. So today's date is 1st March. Till 30th March, 1 month future is given, and till 30th June, 4 month future is given. Okay, now you need to advise, review, and recommend an appropriate hedging strategy for the opportunity. Now, if I need to advise and recommend an appropriate hedging strategy, how many strategies the company is considering? 3. The first strategy is forward exchange, contracts, right? You need to advise, review, and recommend an appropriate hedging strategy. So how many strategies the company is considering? There are 3 strategies: forwards, futures, and options. So obviously, to advise which is the best one and recommend which is the best one, we have to solve all 3 and then decide. We have to solve all 3 and then decide, because that's the only solution. If you need to advise and recommend appropriate hedging strategy, you see the company is considering 3 hedging strategies. So to advise which is the best one, you need to deal all 3 and then decide. The first strategy is forward exchange contract. Okay, it's just a one-line solution. Now go back to the question for forward exchange contract. Remember, it's 3-step. The first step, you are receiving 20 million euros in 3 months. You are receiving 20 million euros in 3 months. So only the 3-month forward rates are relevant, right? If you are receiving 20 million euros in 3 months, only 3-month forward rates are relevant, which are 1.1559 and 1.160. Correct? If the company is receiving money after 3 months, I told you there are 3 steps of forward exchange contract. The first step, only 3-month rates are relevant, right? 1.1559, 1.160. Okay. Second step, the quote. What is the local currency? It's dollar. The home currency of euro is dollar. The rates are $1.159 per euro. Per euro means euro is in denominator. $1.1559 per euro. $1.159 per euro. So dollar per euro. Dollar in numerator, euro in denominator. If dollar local currency is in numerator, that's a direct quote. Direct quote means you have to multiply, and in direct quote, the lower rate is the selling rate and higher rate is the buying rate. I've done the 2 steps. The first step, if we are receiving money after 3 months, only use the 3-month rate. If you are receiving money after 3 months, the only relevant rate is the 3-month rate. So I highlighted only the 3-month rate. Okay. Second thing is the quote. Second thing is the quote. Now it's given dollar $1.1559 $1.1601 per euro. Per euro means euro is coming in denominator. Dollar per euro. Dollar is in numerator, per euro is in denominator. So the home currency of euro is dollar, it's in numerator, it's a direct quote, you will multiply. So the lower rate in direct quote is the selling rate and higher is the buying rate. Okay. Now one last step. How much you are receiving? Euro 20 million. Let's do the working in thousands. Euro 20 million, 20,000. Okay. Will you multiply or will you divide? You will multiply. Okay. So the last step, you highlighted the relevant row 3-month rate. You highlighted the quote, it's a direct quote, you will multiply. Lower selling, higher buying. Last, You are receiving euro 20 million, euro 20,000. You will multiply or divide? You will multiply. It's a receipt. Will you buy or sell? If it's receipt, I will sell. So selling rate is the lower one, 1.1559. So multiplied with 1.1559. It's $23,118. It's $23,118. Right? You solve forward exchange contract. You need to advise and recommend you an appropriate hedging strategy. So obviously, how will you recommend an appropriate strategy? You need to solve all strategies, forwards, futures, options, then decide. So I first solved forward exchange contract, highlighted the 3-month row because the payment was being received in 3 months. The quote, if dollar per euro, dollar is enumerated as a direct quote, multiply. Lower selling, higher buying. It's a 20 million receipt, so I take it in 1,000, 20,000, multiply, do it, multiply. Since it's a receipt, I'm selling rate 1.1559 lower, it's 2311. Okay. Any questions with this you can ask, then we will move towards the second technique because we have to solve all techniques, then recommend which is the best one. So move to the second technique, which is currency futures. Any questions with forward exchange contract you can ask, please. Yes, Nesper, you can do that. And for Julie and MD Rizwan, please pay attention to this note. That's specifically for these two students. It's written $1.1559 per euro, right? It's $1.1559 per euro. So which is in numerator? Dollar. The Lirios local currency is dollar. That's why it's a direct quote. In direct quote, we multiply. That's why we multiplied. And in direct quote, the rule is lower is the selling and higher is the buying, as discussed yesterday and in today's class, that in direct quote, we aren't making those rules. If the quote is direct, lower is the selling, higher is the buying. If it's indirect, lower is the buying rate, higher is the selling. So since it's a direct quote, we need to multiply. Lower selling, higher buying. It's a receipt. We use sell because receipt is always sold. That's why we use the selling rate. Now, no matter it's higher or lower, we have to use the selling rate. Okay. So Lirio was expecting to receive 20 million. It had to consider three techniques: forwards, futures, and options. We discussed which is the best one, recommend. So we need to solve all three. First, solve the forward exchange contract. So we're receiving 20 million in 3 months. So highlight the 3-month rule. It's a quote, dollar per euro, dollar is an inventory direct quote, multiply, lower selling, higher paying. And finally, 20 million is receipt, multiply, divide, multiply, it's receipt. So apply the selling rate, 2311. Okay, let's move towards futures. Now you need to study futures through my technique to make life easy for you. Okay, remember currency futures has 3 steps. Step 1 is to find lock-in rate. Okay, step 1 is to find lock-in rate. So step 1 is to find lock-in rate. Now, how will you find lock-in rates and average rate? Okay, you are given one-month rate, which is in futures you are given 1-month rate, which is 0.8638. It was 30th March, so I took it 1-month rate. And you are given 4-month rate. So what is the 4-month rate? 0.8656. Correct? You are given 1-month rate and you are given 4-month rate, right? 30th March, 30th June. So I took it from today's date, 1st March. It's for 30th March, 1 month and 4-month rate. Okay. You are receiving in 3 months, so you need a 3-month rate. Remember, you are receiving in 3 months, so you need a 3-month rate, which is not given. Which is not given. You are given rate for 1 month, you are given rate for 4 months, you need a rate for 3 months, so you will apply the lock-in rate strategy. So 1-month rate is 0.8638 and 4-month rate is 0.8656. What is the trend? It's rising. Yeah, 0.8638, 0.8656. It's rising. By 0.0018. It's rising by 0.0018 in 3 months. 1-month rate is 0.8638, 4-month rate is 0.8656. It's showing a rising trend, 0.0018 in 3 months. Okay, so per month rising trend is 0.0018 upon 3 months. Per month rising trend is 0.0018 upon 3 months. 0.0006 per month. Correct? 1-month rate, 4-month rate is given. We need rate for 3 months. So you need to find a lock-in rate. So the trend is riding 0.0018 in 3 months. So it's 0.0006 per month. So how will you find the 3-month lock-in rate? See, the 1-month rate is 0.8638. This is the 1-month rate. Okay, 0.8638. It's rising by 0.0006 per month. So if you add 0.0006 one time, so from 1 month it will move to 2 months. And if it's increasing by 0.0006 per month, you need to add 0.0006 0.6 another time. You start from 1 month rate and it's rising by 0.0006 per month. So add 0.0006, made it 2 months. Add one more time, 3 months. So the 3-month lock-in rate would be 0.865. This is how you need to find the lock-in rate. That our given rate for 30th March 1 month, 30th June 4 month, it was rising by 0.0018 in 3 months. So per month was 0.0006. You took 1 month rate, it's rising, so it should be increased by 0.0006 to get to 2 months, and in 3 months 0.865. Once you get the lock-in rate, carefully pay attention. Step 2 is to find expected receipts using lock-in rate. This is the second step. Once you find the lock-in rate, find expected receipts using this lock-in rate. So pay attention. How much was the receipt? It was euro 20,000. The receipt was euro 20,000. Okay. So you need to find expected receipts using this lock-in rate. The lock-in rate is 0.865. The lock-in rate is 0.865. So find expected receipts using this lock-in rate. So euro 20,000 is the receipt. You need to find expected receipts using the lock-in rate, and lock-in rate is 0.865. Will you multiply or divide? Now, if you go back to the question, in futures, see futures here. The quotation is euro per dollar. In the above technique, forward exchange contract, this was dollar per euro. But in futures, it's euro per dollar. Dollar is the local currency, that's a denominator. Dollar is the local currency, that's a denominator, so indirect. So you will divide euro 20,000 divided by lock-in rate 0.865. This will make it 23121. This is you got the expected receipts using lock-in rate. Either you need to multiply or divide. Had it been a direct quote here, I would have multiplied with lock-in rate. But euro 20,000 receipt, lock-in rate 0.865, multiply or divide. It's an indirect quote here, divide. And the last step is to find number of contracts. The last step is to find number of contracts. Okay. How much you are receiving? 23121. How much you are receiving? $23121. It's in thousands. And what is the contract size of futures? It's $125,000. So you are receiving $23121 and the contract size is $125,000. I'm taking $125 because I worked in thousand. How many contracts? If 23121 is the receipt and the contract size is 125, it's approximately 185 contracts. 184.97, it's approximately 185 contracts. This is full marks for futures. That fine lock-in rate, 3-month rate, no 3-month rate is given, 1 month, 4 month is given, rising trend by 0.0006 per month, took the 1 month rate and it increased by 0.0006 each month, 0.865. Receipts using this lock-in rate, 20 million is the receipt, multiply, divide, because it's in the record by the lock-in rate, and $23121 is the receipts, 125 is the contract size, 185 contracts. We are done with futures as well. Okay, any questions you can ask, please. Then we will move towards the last technique. In futures, you have to ignore the material stuff, no unhedged and overhedged, but in options, we will cover that. In futures, you can ignore. Saifur Rahman, Rahim, it's just because the marking scheme says you need to have the contract. So if 23121 is the receipt and 125 is the contract size, you can say, I need 185 contracts. Tagi, because it carries marks. Yes, an as per basis approach, if applied correctly, should also give the same answer, but we don't follow basis approach here. It's not my strategy, but if you're comfortable with that, you can use that, no problem. Ali Akbar Iqbal, we have already discussed an example. If there is a decreasing trend, that's not a problem. It's falling by 0.0006 each month. So from 1 month rate, you need to go to 2 months, it's decreasing, deduct 0.0006 and then deduct 0.0006. We have already discussed that. Almir Hassan Ali, examiner's approach is never fixed. You can go in some questions and say he used basis approach. In some questions, you can say use this approach. Both are acceptable. No need to worry about that. There are 2 questions from Anjali Balan and oh, it's the same question, Anjali. If contract size was in euros. If the contract size was in euros, the number of contracts would be very easy. 20 million euros the receipt and the contract size is 125,000 euros. Euros and euros divide with the contracts. No need to convert. And as per, thank you for the feedback and you can master it. Just look at my September webinar day 2 as well. You will master it. Kritika, you can use the physical calculator. Yevante, underhedged, overhedged will be discussed in options. In futures, you can ignore. It's immaterial, doesn't carry any marks. Shalima, in the exam software, if you can look at the left where my mouse is, the symbol is given, you click here and it will give you dollar, euro, pound, yen. You can insert whatever symbol you like. Anita, you can ignore them in futures. We will cover it in options. Taki, I have already answered you. Number of contracts are not calculated or required to be calculated in real world, but in exam they carry marks. Therefore, you have to continue. I think some of the students are not properly paying attention to the lecture, because I've answered this question already 3 times, that if the contract size would have been in euros, that would have been very easy. It's just a simple thing. Euro 20 million is the receipt, and euro 125,000 had been the contract size. Just directly divide to get the contracts. But it was in dollars, so we needed to convert it first into dollars and then divide. Adreto, you should wait for this question for the next 5 minutes. I will discuss it shortly. Satya, I've already answered this question 3 times. Ambika, interest rate hedging is to be discussed tomorrow. Yeah, gain or loss on futures is in interest rate hedging, not in currency hedging. Tavanna, you're saying we are looking at the ACCA marking scheme and there is overhedged mark available as well. For specifically you, I have opened the solution from futures contract, and you can say that it's 23121 and it's 185 contracts, and it clearly mentions resulting in a very small overheads, therefore not material. Okay, I don't know which scheme you are referring to. Anyways. Let's just move to currency options now. I need you all to pay attention on this specifically, because this is the last technique and the most important one. There are some students messaging questions on the WhatsApp, so please during the class only answer questions, only ask questions on that question tab. I'm replying to one student. but please don't send the questions on WhatsApp. Okay. Now currency options. So firstly, it's a case of receipts or payments. So reply is it's a case of receipts. So you know the formula for total receipts is expected receipts in our currency using exercise price plus unhedged receipts minus premium pay. Okay, I just told you that this is the formula of receipts. It's expected receipts in our currency using exercise price plus unhedged receipts minus premium pay. Okay, we will compute all of these things shortly. Okay, and then we can just recommend them which is the strategy best, because once we solve all three, we will be in a position to address that. Mohammad Fazal, I have already shared the notes. And the Rizwan, I've already answered that it's an examiner requirement. No need to write the formulas. Okay, so we need to compute three things for this. Total receipts is equal to expected receipts plus unhedged minus premium pay. Okay. Now let's start with the first thing, that is expected receipts. Now the formula of expected receipts is as I told you, number of contracts multiplied by contract size. See, I made you write the formulas. The formula for expected receipts is number of contracts into contract size. Okay. And how do you compute the number of contracts? It's expected payment or receipt in foreign currency divided by exercise price over contract size. Okay, so let's just do it. So expected receipts, the number one thing is number of contracts into contract size. And number of contracts is calculated as a formula, expected receipt or payment in foreign currency over exercise price divided by contract size. Let's start. What is the exercise price? It's 0.86. As you can see in options, the exercise price is 0.86. So expected receipts in foreign currency for number of contracts. It's expected receipt in foreign currency euro. $20,000. divided by exercise price. The exercise price is 0.86. Divided by contract size. So contract size is $125 because I'm dealing 1,000. This is for number of contracts. So this gives us 20,000 divided by 0.86 divided by contract size. It's 186.04 contracts. No one is going to give you decimal contracts, so you can round it up or down, but my strategy is to down. Take 186 contracts. Okay. This was the subformula of number of contracts. I told you number of contracts is computed in this manner. It's expected receipts in foreign currency over exercise price that's given divided by contract size, 186.04 contracts. If you will do it 187, that will be overhedged. That's also allowed, but my strategy is to underhedge, reduce the decimal figure, round down. So 186.04 contracts or 186 contracts. This is the number of contracts. Okay. Now you get the expected receipts as follows. Expected receipts. It's basically number of contracts into contract size, which is $125. $23250. So this is the first thing I've calculated. Expected receipts is 23250. The formula of expected receipts was number of contracts into contract size. The formula for expected receipts was number of contracts into contract size. So number of contracts was expected receipts in foreign currency divided by exercise price divided by contract size. 186.04 contracts, you can round up. 187, that will become overhedged, but I advise you to make it down underhedged, 186 contracts, so that it remains underhedged. So expected receipts are 186 contracts multiplied by the contract size, that's 125, it's 23250. You got the expected receipts. Okay. Any questions in expected receipts? Okay. After that, the second thing which we have to do is to find unhedged receipts. Now remember the formula of unhedged receipts. I told you at the beginning the formula of unhedged receipts. Here it is. Expected receipt in foreign currency minus number of contracts into contract size into exercise price. Okay. So it's expected receipt in foreign currency minus number of contracts into contract size into exercise price. Okay, so it's expected receipt in foreign currency minus number of contracts into contract size into exercise price. Now listen to this carefully. Okay, I'm finding unhedged receipt. How much is the expected receipt in foreign currency? The expected receipt in foreign currency is euro 20,000 minus how many contracts did you take? 185 into what was the contract size? Dollar 125 multiply by what was the exercise price? 0.86, right? Your expected receipt was 20,000. Understand the concept of this formula. Your expected receipt was 20,000 euros, but you only took 185 contracts, having a contract size of 125 with an exercise price of 0.86. So you can see 20,000 was the receipt, but you only took 185 contracts at 125 price at 0.86 exercise price. So you were only able to hedge 19,887 through this. So you were expecting 20,000, but you were only able to hedge 19,887 with 185 contracts, 125 contract size, 0.86 exercise price. So whatever is left, that's unhedged. 112.5 euros remain unhedged. 112.5 euros remain unhedged. Right? You were receiving 20,000 euros, but you weren't able to hedge those 20,000 euros because you only took 186 contracts. I'm sorry. It's 1,995.5 euros. Sorry. You weren't able to take full 186.04 contracts. You only took 186 contracts at 125 at 0.86. So 20,000 euros was the receipt, but you were only able to hedge 1,995 through this. So 5 euros remain unhedged. And now, no technique is going to hedge this unhedged amount, 5 euros. So there is only one technique, forward exchange contract. You will hedge this 5 euros through forward exchange contract. Okay. So 5 euros through forward exchange contract. 5 euros through forward exchange contract. 5 euros through forward exchange contract. In forward exchange contract, remember you use forward rates. In forward exchange contract, remember you use forward rates. So go to forward exchange contract. Which forward rates will you use? 3 months, obviously. The payment is after 3 months, so 3-month forward rates. So you will use 3-month forward rate, and it's a receipt. It's a direct quote in forward exchange contract. Remember, it's a direct quote in forward exchange contract. So you need to multiply. And receipt selling rate in direct quote lowers the selling. You need to multiply it at 1.1559. Multiply by 1.1559. Exactly the same which you did in forward exchange contract. So 5 multiplied by 1.1559. It's 5.78. Now, why did we multiply this in option? This was an indirect quote. Yes, in option, it's an indirect quote. In indirect quote, we divide, but this unhedged is being hedged through forward exchange contract. This unhedged is being hedged through forward exchange contract. So in forward exchange contract, the quote is direct. You apply this €5 receipt through forward exchange contract. It's a direct quote. It's multiply. Lower selling, higher buying receipt. Selling rate 1.1559. It makes 5.78. So you have done two things. Expected receipts through the formula. It's 23250. And unhedged through the formula, but it was hedged through forwards. Okay. Any questions up till now? Yes, Julie, you can do that. I told Ayuni that whatever is unhedged, because of standardized contract size, no technique hedges this, neither futures, neither options, because they've standardized. So this unhedged petty amount will only be hedged through forward exchange contract. Yes, Alvin, if there are two exercise prices, you need to work for both. Kritika, I would advise you, you can just wait for 5 minutes. Let me complete the question. This question will be answered. As you can see in this question, only one exercise price was given. 0.86. If two are given, you need to work on two. In the September webinar, I did a question where two exercise prices were given. You need to use both. Here is one given, we need to use one. Alvin, you have to use the both exercise prices, otherwise you will lose marks. Maureen, when 186 contracts are multiplied by 125, it's dollars, but when it is multiplied by the exercise price, it's converted into euros, because the exercise price is euro per dollar. Number three thing which we have to find is the premium payable. And we have already discussed the formula of premium payable is number of contracts into contract size into premium. Now, we all know that number of contracts are 186. Listen this carefully. This is the last thing. We all know number of contracts are 186 into contract size. We all know that contract size is 125. Premium. How to get the premium form? Now listen this thing carefully. This is very, very important. I need you all to stop doing any stuff and pay attention here. Now number of contracts are 186. Contract size is 125. We all know this. What is the premium? Now premium in options is this. You see what is mentioned as 0.0255, 0.0290, 0.0267, 0.0319, which is mentioned calls and puts in front of the exercise price. This is the premium. This is the premium, which is mentioned as March premium, June premium, March premium, June premium in calls and puts. And I know that March, June means I've already told you 30th March, 30th June, or 1 month, 4 month, whatever. Okay, so premiums are given 1 month, 4 month, calls 1 month, 4 month, puts. Premiums are given in front of exercise. You're working on 0.86 exercise price. So for 0.86 exercise price, the premiums are given. But the biggest problem for students is that we cannot select all 4 premiums. Only one is relevant. Out of all these 4 premiums, only one is relevant. I have to take one premium amount. So which is the lucky premium which I just choose? Now listen carefully. How do you reach towards that one premium? Now listen carefully and see me, please. Watch me. Pay attention to me. Now, the first thing to reach towards the proper premium is that decide whether it's a call or a put. Decide whether it's a call or a put. Sir, you taught us that it's a receipt case. In receipt, we have to sell currency. Use put option. You're 100% right. It's a receipt case. In receipt, we have to sell. It's a put option. And had it been a payment case, we have to buy currency, call option. You're right. In receipt, put option. In payment, call option. But listen this carefully. You cannot rote learn anything in AFM. You have to understand the concept. I am in US. Lirio is in US. Listen this carefully. It's very important. Lirio is in US. Home currency is $1. It is receiving 20 million euros. It is receiving 20 million euros. Look at me. It wants to sell euros. It is receiving 20 million euros, so it will sell euros. Sell euros means it will use a put option. Sell euros means it will use a put option. They went to the money changer who is offering this options contract at the bank and saying, we are receiving 20 million euros. We need to sell it. Give us put option for euros. He says, sorry, I am offering contract size in $125,000. I am offering contract in dollar. I'm not offering contract in euros. I'm offering contract in dollars. So you are receiving 20,000 euros. You need to sell euros in US. Take a put option for euros. But the money changer or bank isn't offering contract in euros. They're offering in dollars. So see in US, selling euros means not returning empty-handed. Selling euros means taking dollars, and taking dollars means buying dollars. If he is giving contract size in euros, you need to sell 20,000 euros, take put option. But since the contract size is in dollars, selling euros means buying or taking dollars. So since you are buying or taking dollars, not buying or taking euros, you are buying or taking dollars. Buying dollars means you will take call option for dollars in this question. Now this just breaks all the previous things that student was thinking that I can rote learn in receipt always put option, in payment always call option. Wrong. It is right in 90% scenarios that in receipt you sell put option, in payment you buy call option, but it entirely depends on the contract size. Many students were asking question in advance. I am repeating them again. Had this contract size been euro 125,000, the money changer was offering contract in euros. I'm receiving 20,000 euros. I need to sell euros, and sell euros means I need to take put option for euros. I would have taken put option in this receipt case. The money changer is offering contract in dollars. Selling euros means taking dollars, buying dollars. I won't return empty-handed. Sell euros, take dollars. Since I'm taking or buying dollars, he's offering contract in dollars. I'm taking dollars, call option. Similarly,
don't rote learn that in payment we will always take call option. Let's suppose I'm in Pakistan. Please pay attention. This is a very important concept. I'm in Pakistan. My local currency is Pak rupees. I need to pay someone $1,000. If I need to pay someone $1,000, I need to buy dollars. And buying means I will take call option for dollars. I go to the money changer. He's offering me contract in dollars. I need to pay $1,000. I need to buy dollars. He's offering contract in dollars. I will take call option because buying dollars. But let's suppose I have to pay $1,000 to someone. I need to buy dollars. I go to the money changer. He says, sorry, we are offering contract in PKR. So I won't say, okay, sorry. I would think that I need to buy dollars. Buying dollars means giving him something. Yes, PKR. If I will buy dollars, I'm giving PKR. I'm buying dollars, selling PKR. If he's offering contract in dollars, I'm buying dollars, take call option. If he's offering contract in PKR, I am not buying PKR, I'm giving, selling PKR. So even in payment case, if the contract size is in PKR, I'm selling PKR, I will take put option. Here I'm receiving 20 million euros. So you are absolutely right. That 20 million euros receipt, we need to sell dollars, we are receiving 20 million euros receipt. We will sell euros, take put option for euros, but the contract is not in euros. Else I would have sold euros, took put option. The contract size is in dollars. So I'm receiving euros, I'm selling euros means put option, but the contract is in dollars. So I'm selling euros, taking dollars. I'm taking dollars, selling euros. If the contract is in euros, take put option. If the contract is in dollars, I'm taking dollars, take call option. So you will take call option, both put options get exited. I will take call option. Now call option has two premiums, 1 month, 4 month. I am receiving money in 3 months. So 1 month would get over. No lock-in rate here, that's only in futures. 1 month, 4 month call premiums are given. I will only take 4 months because I'm receiving after 3 months, 1 month would have expired. 4 month premium 0.0290 will be taken. So I take 0.0290 premium here. This will make it 186 into $125 into 0.0290. 674. $674.25. This is the premium, okay? And this premium has to be paid immediately. So this premium 674.25 euros has to be paid immediately. Immediately means how will you convert this? Euro 674.25. This premium has to be paid immediately. You have to pay 674.25 premium immediately. So in immediate, what rates do you use? In immediate, we use spot rates. In immediate, we use spot rates. So you have to pay 674.25 premium immediately. Use spot rates. The spot rates have a direct quote, dollar per euro. It's multiplication. Lower is selling, higher is buying. Since premium has to be paid, 674 euros premium has to be paid. Okay. So since this premium has to be paid, I will use spot rate, and payment premium has to be paid. I will use the spot buying rate 1.1618. This makes it $783. So I'm done with everything, all three things. Now I can find this total receipts. That this total receipts is based on three things.
This total receipt is based on three things: the expected receipts, which is $23250 number one, plus unhedged, that is $5.78, minus the premium payable, that's $783. So the final answer would be 23250 plus 5.78 minus 783, it's 22473. Now you have got all the techniques with you. The answer of all three techniques are with you. The answer for forwards was 23118. The answer for futures was 23121, and the answer for options is 22473 in receipt, which should be advised. Obviously, in receipt, the technique should be advised, which is giving highest. So futures, in my opinion, is giving the highest answer. We will opt for futures. Okay, this is advice. However, it shouldn't be like such small. You need to read the answer to understand how the examiner writes answer. But I have explained you in a very easy stepwise manner that how do you find expected receipts number one, then unhedged minus premium payable. The call and put only comes in premium. Receipt, remember, in receipt we have to sell put option, in payment call option, but it depends on contract size. I'm receiving euros, I need to sell euros, take put option for euros, but selling euros means taking. Since I'm taking dollars, selling euros means taking dollars, and he's offering in dollars. Taking dollars means call option. Any questions you can ask, and I would advise you all that once you are willing to adopt this method, then in September webinar I taught one question which is like this. So if you're willing to adopt this method, you need to view that video as well so that the grip is increased. Ambika, we used the 4-month rate because 1 month period would have expired. My payment or receipt was in 3 months, so I will be needing a 3-month rate. So 1 month and 4 month, and year one is 4 month. Jasmine, it's just due to thousands or millions. So I don't think the first 4 figures are correct, 2312. So that's fine. No need to worry about the answer then. Balaj, I've told that there's no need to write the formulas. Musa, you can use any two which is falling in the middle of your desired one. Yes, are unique, perfect. If you won't calculate unhedged portion in exams, Srendi, you will lose marks. Okay, Balaj, for you, we are repeating this, that since we are receiving 20 million euros, so in receipt we take put option. But it depends on the contract size, which currency is offered. If I'm receiving euros, I will sell euros. Sell euros means take put option of euros. If money changer is offering option in euros, I will take sell euros, take put option. But selling euros means taking dollars. In US, selling euros means taking dollars.
So the only basic issue regarding this is that you have to clearly understand which currency we are dealing it in options. You cannot just randomly state that I will use call option in payments and I will use put option in receipts. It is 90% clear, but still you need to make sure that it entirely depends on the contract size. If the contract size, I need to pay someone 1,000 euros, I need to buy euros, take call option for euros, but buying euros means selling dollars. If the contract is in dollars, I'm selling dollars, take put option. But if the contract is in euros, I'm buying euros, take call option. Okay, so
Just take the questions. Satya, if there are 3 exercise prices, you have to solve all and then decide which one is the best one. I've already provided WhatsApp number multiple times. I'm sending that again. So this is the end of our today's session. If you have any questions, you can ask. And again, before leaving, would be grateful if you people give your feedbacks so that this helps us to improve the experience. Thank you. These are very easy methods, and I would strongly advise you to watch the September video of day 2 as well, so that you get a crystal clear grip on this. I'm waiting for the feedback, please, and request to all you, please give the feedback and then go. Satya, I've answered your question 3 times, that if there are 3 exercise practices as well, you need to solve all 3, decide which is the best one among them, and then decide after comparing with other techniques. Waiting for the feedbacks, please. Bharati, you can contact me through WhatsApp. Yes, Anjali, I'm not teaching anything else. So after feedback, you can leave. Ambika, after 35 minutes, you will be added. Don't worry. Okay, so then let's end the session and we will see you tomorrow.